Welcome to Navigating the Minefield, where I'll be talking to Eric Maszynski about the latest goings-on in the mining and commodity sector. We recorded this on the 5th of December. That was the day after that all-time high spike in gold. That was on the 4th of December. Obviously, this is being released on the 10th of December, so sometime after that. But we wanted to talk about how the actual short-term gyrations in the gold price shouldn't actually affect the thesis of investing in some of these junior mining names, because for Eric, this is a long-term game. It comes with a lot of risk and a lot of volatility, which we've expressed and explained in previous episodes. But more importantly, it's all about what is the long-term thesis and seeing through the short-term noise to build a portfolio based on a long-term view of gold and of gold miners and things like silver as well. Welcome everybody to the fortnightly Navigating the Minefield, where we're predominantly looking at the market through the lens of commodities and mining stocks, but also we will be touching on other things such as crypto through our time. Very good to have Eric with me again. We're recording this on the 5th of December, the day after we got a new all-time high on the gold price. Although this is going out on the 10th, I think it's worth putting this into context, because I think it's worth talking about that move in gold. But also what I'd love to sort of talk to you about is how the important thing for you is not actually chasing price per se, but thinking about these things in a sort of broader, longer term framework context. Now, just before we go on, I just want to remind everybody that this is for educational and engagement purposes, and none of this is investment advice, and everybody obviously has their own risk tolerances and their own reasons for investing, so please do your own research. But having said that, we got this move. It was quite, for a short period of time, Eric, it was quite a phenomenal move in gold before everybody woke up, not just in the US, but also in Europe. You've always said it needed to break 2100. It broke to 2140. Does that count?
Technically, what we're going to want to see is a monthly close above 2100 to like officially make that the real deal absolute breakout. It's 3.5 long weeks away before we're going to see what the verdict is there. But I'll give you a tidbit of information, which is that every single major breakout in the price of gold since 1974 has hit a new high and then corrected back to either the 20 or 50-day exponential moving average. In this case, they're not far away. I believe it's 2020 and 1975 are those numbers. So this probably won't be any different. Investors should hope that we see a bit more time before this thing really starts to go, and that confirmation is confirmed, because that is when you're going to be doing the woulda, coulda, shoulda type of thing, pretty fast, because gold's going to 25 to 2,700 once that breakout is official, I think, in very short order.
We've been hoping that we would get a breakout, because one of the reasons we timed this series the way we did is you could see that big level was approaching. But at the same time, you're saying it was whatever time, Sunday night your time, it was the Asian markets open and basically straight up there, straight back down. So not really what you call a convincing break, a little bit of a head fake. The most important things when you think about this is not, oh, the price has gone up, now let's chase it. But actually, in some ways, you always think about it almost the other way around, which is when the price was down is when you should start accumulating. So I think it's worth reiterating here how you think about your framework, because yes, we might get a price move, and yes, that might confirm some of your thinking, but actually chasing price is not really what you want to be doing, is it? Particularly in some of these junior names.
Listen, it's not how you invest profitably. I mean, I couldn't really care that much less about day-to-day activity in the gold price, spot gold price. I mean, this particular situation with gold has been a 12-year process that we're talking about since it hit those highs, near 2000, back in 2011, right? We have had our various stages for over a decade, and now just in the last several years, right now, this is a quadruple top on an all-time high in a major asset class. I actually don't care if we're trading bananas or gold or molybdenum. This is a very, very huge breakout. It's not going to be super easy to go through there. We've had 3 stalls that have seen the pullbacks and consolidation on this new level of, 1800 to 2050 or whatever it's been. Gold could continue to do that consolidation for another year, and it wouldn't affect my thesis. The fact in my head, it's just a matter of time. This is what gold does. Gold is the store of value, and it's going to go through that 2100 mark. But the problem that we have is that a lot of investors just aren't ready for it, especially when you segue over into the mining stocks. My fear as the editor of the Gold Investment Letter, where I have, a lot of investors that listen to my musings around this area, you better reset your head. If you're not starting to feel really greedy right now, like in terms of, I need to get in there and start buying this stuff up on the miners, then you're emotionally upside down from where you should be. And most people are exactly right there. But that also, that's what creates this opportunity. And anything that's going to break out on a quadruple top, that's, a 12-year-old top that's being broken through, has tested it, again, 3 times in the last few years, and is going to break through that number convincingly on the monthly chart. We know as traders, like, it's not going to 2250 and stopping, and then it's going to go back to 1500. It's very unlikely. This is going to 2600, and my target, we get a monthly close above 2100. Within 18 to 20 months, gold will touch $3,100 to $3,200 an ounce US.
There's a lot of investors who sort of think about any asset. It's going to be a case of, okay, what might be those drivers? And, we've seen crypto move, NASDAQ move. It feels like the market's been pricing a pivot, a central bank that's going to be reducing rates. We've seen yields coming down. All these have been positives. Now, obviously, that creates this uncertainty, because obviously what might be happening is that if the market thinks the Fed's going to move, and we've seen a move that we've seen in bond yields, the move that we've seen up in equities, actually means the Fed now might be able to go, well, we can actually keep our tightening bias, which actually might keep the volatility in all these assets quite high. And as I think you said last week when we were talking about the sort of how to kind of think about running a volatile portfolio of liquid assets, if you only want to limit yourself to a 10% drawdown, maybe these are the things for you. But of course, what you also said very clearly is that for most people, these are the sorts of assets which have a place as a part of a portfolio, not as the whole of the portfolio. So obviously with that caveat, but some people will be thinking, oh my God, yes, they could break out. I could get into them now and they could be down 20, 30% again. But you still think, and I think the key thing here is that you've got to have a framework and you've got to build, because one thing I think was very clear from last week is that once the chase is on in these sorts of names, because often many of them are illiquid, with many people chasing them, you just won't be able to get your positions on in any meaningful way. The downside of that is if you go early, you might have to deal with some bigger drawdowns as these things still adjust before that move out.
Some of us, are like the junior mining exploration wildcatting junkies. And so, we love some of the smaller ones. Like if it's a company with a sub, 10 million or 15 million or $20 million Canadian market cap, I'm shopping in that area. And I have been for months, because you don't really get many companies that are going to get financing through a syndicate, or at least a particular lead order and underwriter, unless you're raising like at least $5 million. Otherwise, it just isn't worth it for them. So what has happened in this space is that the smaller companies have had to do almost exclusively what they call non-brokered private placements. And I think part of my thesis here is that because of the underinvestment in these areas, and then also the tax selling, what has happened is that you've got the machines now are very active in all these markets, and they've been leaning on a lot of those smaller juniors, because we've had over a 3-year bear cycle, and then we come into this really pristine environment in late 2023, whereas many asset classes are up. Most people have very good, healthy returns in general equities. In other areas, crypto's up quite a bit. So when you're looking at your portfolio and you need to offset some of that with losses, The mining sector has been ideal, and we've seen that. So that's an additional punishment. The lack of liquidity in a lot of the smaller names, people just walk away. They're like, I'm not going to mess with this thing. That's all changing, and it's going to change in a big, big way. But again, we have to be early for this stuff. That's why with the drawdown thing, I was laughing at 10%, because I've been early in some of the names started accumulating 2 years ago and had to endure this bear market. But I accumulate so that it's sustainable, and I've got income, and I've got, cash on the side to continue to build positions. If you don't get into the mindset to start buying out offers and going high bid in some of these liquid names that you like a lot, and you don't do it now, we're going to have a situation going into the end of the year, and gold does not need to go through 2,100 for this. If you don't get your positions on in some of these small ones and feel comfortable having a drawdown on paper, you're just never going to get your positions and make a fortune in the plays. You're going to be chasing the stuff alongside of everybody else that waited too long.
You talked about how you enter these positions and how you do it over time and your thinking behind that. So I think I would urge people to have a look at that, because that was a way of managing risk and managing entry and exit points. But two things we talked about 2 weeks ago, you obviously alluded to some of these just now, which is the tax loss selling, and also often, but not always, January is good seasonality for gold, and therefore if that tide is rising, other things can come through. We don't know what's going to happen in terms of price, but in terms of tax loss selling, how do you feel that that's now mainly complete?
In many names, the majority of names, tax loss selling season is already over, which is why I've been ringing a bell and like a siren saying action, activity, deploy capital, accumulate right now. Because whether some of these names, are already done with the tax loss motivated sellers on the larger part, or it's in 2 weeks, like that's basically it, right? I mean, the end of the year's coming pretty darn quick. So it's pretty much, I think, mostly been done. And I was of the opinion it would end a little bit early this year, because it was so evident that this sector was such a target for those tax losses. We saw a little over a week ago, one of my biggest position in the mining market, somebody came in and blasted the thing aggressively for 2 days, and it came back down, and it was either tax loss motivated, I believe, or like a margin call perhaps. But that's what I see generally with a lot of these names. We've seen some of these older plays that I've been in and out of for a decade. We saw a couple last week that doubled, and one of them tripled on massive volume with no news, because they're just overdone and the selling was finally over. So it's a case by case, but I think for the most part, tax selling season with the gold and silver miners and the juniors, it's pretty much done, and that's why I'm buying.
And for those outside the US, is the actual, the final cutoff, is it the 31st of December?
I've never seen activity, very much activity after December 15th, no matter the market circumstances. And then you also, after 30 days, you can buy this stuff back. So I think some people get a little bit motivated that they're going to lock it in. They did it in October, November, early December, and then they're looking to get back into some of these names after 30 days after we cross over into 2024. So yeah, give it a week, and the tax loss selling will be 90% over, in my experience, just from the duration of the calendar. Maybe December 17th, 18th, something like that. It'll be at least 90% done.
From my perspective in sort of macro sales, it was always the third Friday of every December, because the third Friday is the big expiry in the equity market for triple witching, quadruple, if you want to still think about the old days. And that happens to be the 15th this year. It's nearly always somewhere between the 15th and the 21st of December. And that's basically where everybody kind of clocks out for the rest of the year. Europe goes on holiday for Christmas, etc. So you do have a natural liquidity drop-off after that third expiry, which is a massive volume day generally, and then boom, it goes quiet. I think the other thing that was interesting that you mentioned, which I think is again worth reiterating, which is in some of these names, you can have these very, very short, sharp periods, bursts of selling, which can see these significant drawdowns, which is one of the reasons you say that in the minor ones, you tend not to have stop losses, because most people's stop losses might be 5 or 10% down. These things will go through because they're small caps, but you accept that because that's part of your risk profile and how you deal with these things.
step number one is value. There has to be fundamental value that I see in the companies before I'm going to get very excited in regard to, plunging into these different deals. But I also know that my biggest winners in the past, and I've been very lucky. Like if you look at the junior mining sector, there's a lot of people, even I think on our first video, that were like, say goodbye to your money. I love that. There's trolls everywhere. When you're dealing with proving up real assets and you can actually buy X amount of third-party verified gold in the ground, the grades, the makeup of what could be or, is not going to be a mine. It's just a matter of how much capital and going through these stages. There has been value built into those. And the discount that we've seen, the disconnect, especially this year in the equity valuations versus what a lot of these companies have, is utterly ridiculous. And then you start to look at some of the NPVs. It's crazy. I mean, they're not even trading anywhere near NAV. And in very strong markets, you can see companies gobbled up for 3 times NAV, 5 times NAV. It happens. But certainly in some businesses, especially when they're cash flow positive, they're ramping up and growing, you're going to get multiples of net asset value. And in this case right now, when I see stuff like that, I just don't care about the gold price, because it's just an orphan play that's been left for dead, and nobody cares because of the nature of the market. Nobody's taking action, and that makes me salivate.
So that kind of leads us on into what we'll be looking at next week, where we're going to sort of think about how to map out a strategy for investing in these stocks. And we're going to name some names. You're going to name some names, but again, they'll be just the ones that you look at and the reasons why. So I look forward to that conversation where we'll have a look at some of the ones that you're focused on at the moment.
Let's roll into the next one where we can talk about some interesting ideas.